Right now, AAON Inc. is trading at $105.00, which is a massive intraday move, up $11.54 or 12.35% on the day. And let's be perfectly clear, this is not a random spike. This isn't just a simple earnings beat that has analysts slightly adjusting their price targets. What you are watching today is the live, real-time repricing of a company based on a fundamental shift in its business. The market has suddenly realized that the company it thought it was tracking, a high-quality but somewhat predictable manufacturer of commercial heating and cooling units, is not the company that just reported its third-quarter numbers. The expectation was that AAON was a steady industrial, a show-me story that was struggling with some internal operational hurdles, especially after the stock had recently dipped below its 200-day moving average, causing some concern for investors doing self-investing and watching their charts on the Fidelity mobile app. The reality, as revealed this morning, is that AAON has a secondary, high-speed business hidden inside it, and that business just reported 96% growth. For years, the common belief about AAON was straightforward. They build custom, high-efficiency premium HVAC systems for commercial, industrial, and institutional buildings. Think schools, hospitals, and office parks. It's a great business, a necessary business, but not typically the kind of business that excites the same investors who trade Tesla stock or watch every tick of NVIDIA stock. The narrative was about quality, reliability, and long-term steady growth. But that narrative has just been challenged in a profound way. The Q3 earnings call wasn't just about HVAC units, it was about data centers. It appears that while the market was focused on the company's well-documented operational struggles, specifically a painful new ERP system implementation and the costs of bringing a new Memphis facility online, its BASX segment, which makes highly specialized liquid cooling equipment, was quietly becoming a critical supplier to the data center and artificial intelligence build-out. Today, the market is being forced to reevaluate. Is this a 15 times earnings industrial company, or is it a 35 times earnings tech infrastructure company? The 12% jump you're seeing today is the market shouting that it believes it's the latter. Let's get right into the numbers from this morning's report, because they tell the entire story of this expectation versus reality disconnect. The headline number was revenue of $384.2 million for the quarter. The analyst consensus, what the smart money firms using sophisticated platforms from interactive brokers were modeling, was somewhere between $332 million and $337 million. AAON didn't just beat that estimate, they crushed it by more than 13%. This is the kind of massive revenue surprise that is almost unheard of for a company in this sector. But here is the critical detail. That beat was not evenly distributed. The company's BASX branded sales, the part of the business that is laser-focused on data center and liquid cooling solutions, surged an incredible 96.8% year-over-year, coming in at $124.8 million. That one segment is now responsible for nearly a third of the company's entire revenue stream and is growing at a rate that you'd expect from a software startup, not a decades-old manufacturer. This brings us to the tension. The reason this stock is so fascinating today is that this explosive growth is happening at the exact same time the company is fumbling on other key metrics. This is the reality that investors must grapple with. While revenue was exploding, the company's gross profit margin actually fell, contracting to 27.8% from 34.9% in the same quarter last year. And adjusted earnings per share, despite beating the lowballed estimates, came in at 37 cents. That's a 41.3% decline from the 63 cents they earned in the prior year period. This is the core conflict. AAON is a company that has strapped a rocket engine to its back while simultaneously trying to fix the landing gear. The operational inefficiencies from the ERP system rollout and the unabsorbed fixed costs from their new facility are a very real and very significant drag on profitability. The market, for now, is saying it doesn't care. It is completely ignoring the 41% EPS drop and focusing exclusively on the 96% growth in the BASX segment. The bet is that the revenue growth from the AI boom is permanent, while the margin and profit problems are temporary. And there is a very good reason to believe that growth is here to stay: the backlog. AAON reported a record backlog of $1.32 billion. To put that in perspective, that is more than a year's worth of revenue at the old run rate, all locked in and waiting to be built. This isn't just a single good quarter, it's a pipeline of demand that is so enormous it ensures high-paced activity for the next several years. This backlog is a clear signal that the demand for data center cooling is not slowing down. As AI models become more powerful, they generate more heat, and the need for AAON's specialized liquid cooling becomes a non-negotiable part of the infrastructure. This is why you see major institutional holders, the kind that power Fidelity mutual funds and Schwab Intelligent Portfolios, maintaining large positions. They aren't trading this stock on the Robinhood app. They are making a long-term bet on a fundamental trend, and the Q3 report just gave them all the validation they needed. The high institutional ownership, hovering around 80%, from names like Vanguard, BlackRock, and William Blair, provides a strong floor. In fact, recent filings show that FMRL, the parent of Fidelity Investments, has been an active holder. This isn't just a retail-driven story. So, what does AAON Inc. actually do? Let's quickly break it down. The company operates through three main segments. First is AAON Oklahoma, their legacy business, building large, custom-engineered rooftop HVAC units, chillers, and air handling systems. This is their premium, high-efficiency core. Second is AAON Coil Products, which manufactures a variety of heating and cooling coils used in their own systems and sold to others. This segment has been at the center of the ERP implementation issues. And third, the star of the show, is BASX, which they acquired. This segment is the one designing and building the high-performance cooling solutions, clean room walls, and other precision systems for data center, semiconductor manufacturing, and biopharma. The market used to value AAON based on the first two segments. As of today, the market values AAON based only on the third. The BASX data center segment has effectively become a high-growth tech company that is being given to investors by a traditional industrial manufacturer. This pivot couldn't be timed better if we look at the macroeconomic picture. On one hand, you have high interest rates, which are a major headwind for new commercial construction, AAON's traditional market. That part of the business faces a real risk of a slowdown. But on the other hand, you have the digital technology revolution and the AI build-out, which is creating a tidal wave of demand for new data centers. This trend is completely independent of interest rates. Companies will build data centers in a 10% rate environment if the demand for AI is there, and AAON's BASX branded sales are living proof. The company is perfectly positioned to benefit from the megatrends of energy efficiency, decarbonization, and, most importantly, the intense cooling demands of artificial intelligence. This is why you see major institutional holders, like analyst ratings, have been so strong, with a strong buy consensus. Oppenheimer recently set a $112 price target, and Davidson was at $105. With today's move to $105, those price targets are now in the rearview mirror, and we should expect a flurry of upgrades in the coming days as analysts scramble to update their models to reflect this new growth narrative. The BASX data center segment grew 96%. Comment below what percentage of AAON's total sales you think that segment will be in 2 years. Looking forward, the future for AAON is all about execution. The opportunity is massive, but the risks are just as tangible. The primary catalyst is the $1.32 billion backlog. As the company begins to work through this, investors will be watching one thing and one thing only: margins. Can they fix the ERP system? Can they absorb the costs of the Memphis plant and improve production efficiency? If they can, and the gross margins start to tick back up from 27.8% toward their historic 30 to 35% range, this stock will look incredibly cheap even after today's 12% jump. The bull case is that margins bottomed in this quarter, the operational issues are being solved, and AAON is now a 30% revenue growth company with expanding margins, a powerful combination for any investment. But the risk is that they fail to execute. What if the ERP problems are systemic? What if the new factory remains a drag on profits? In that scenario, the $1.32 billion backlog becomes a curse, a mountain of low profitability work that traps capital and disappoints investors. The company's balance sheet is also a concern, with very little cash and a significant revolving credit balance. They need to start generating positive cash flow from operations, which they anticipate in the fourth quarter. This is the new expectation versus reality. The old expectation was a slow and steady industrial company. The new expectation, born today, is for a high-growth, high-margin tech infrastructure provider. The reality, for now, is a messy, complicated mix of both. The stock surged